taxes is not the best conversation to have, but it's an important conversation to have. So tax planning, how that affects you, especially around your 401k or your Roth 401k or your investment vehicles, is critically important. So let's get into it this week here on the Wealthy Pilots Podcast.
We've got some turbulence up ahead. Reach out to the Pilots Planner.
Hey everybody, welcome into the podcast with Scott and I as we talk investing, finance, retirement, all that good jazz. And Scott, we got to talk about taxes a little bit. Not the sexiest of conversations, but a very important one because let's face it, right? It can make or break your whole deal and how much taxes you're paying or, subject to paying, right? So let's have that conversation this week. How you doing, my friend?
Great. How about yourself?
Doing pretty good. Hanging in there. Looking forward to chatting with you a little bit. I think I want to talk a little bit about maybe the critical differences. Have you kind of break this down between, traditional 401ks, which most of us have. Now, since the Secure Act 2.0 was put into place a couple of years ago, more companies are starting to do Roth 401ks now, which is great. It's a great vehicle. But let's talk a little bit about some of those differences and just kind of give some footing here for folks to think about when it comes to tax planning and tax efficiency.
Yep. Yeah, absolutely. So, ultimately inside of that 401k, most people, they look and they say, hey, I got my 401k balance. That's what's in my 401k. 401k actually has typically three sub-accounts in it, kind of three different classifications of how that money is taxed. You have the taxable or the after-tax account. That after-tax account is funded with after-tax money. And then the growth is taxable later. You have the tax deferred account where that money goes in pre-tax. It grows tax deferred, and then you pay the tax bill on it when it comes out. That's the most common default option. That's where people have probably 90+% of their money.
Right. We're kicking that can down the road.
Yeah, exactly. Yeah. Hey, I'm taking the tax deduction now, and I'll pay the taxes on it later.
Yeah.
And
that's what we've been taught. We've been that's been like beaten to us for 40 years.
Well, and so much of it is, I think we talked about this before, it's just the default. It's literally like I enroll in the plan and it just is the default option. I don't know or think about it. So I just keep going, especially if I'm a new pilot with zero assets. I'm just, and I'm rolling. So,
exactly.
And it's definitely better than doing nothing. And then the third bucket here is this Roth 401k bucket. Roth funded with after-tax money. So I get paid, I pay the taxes on it, it goes into the Roth 401k. The match also goes into the Roth 401k, and then it grows tax-free, and later on when I distribute it, I have tax-free money to live off of in retirement as well.
Which is a great vehicle.
It is. Yeah, I love Roth. Huge fan of it. I try to get as much of my money over there as I can, mainly because if you look at a lot of our pilots, they're in those higher tax brackets.
Exactly. So which typically, Scott, they make too much for Roths, right?
Yeah. Most pilots are not going to be able to make a traditional Roth IRA contribution.
Exactly. Yes. Thank you.
Because the Roth IRA contribution has an income limit. That's not the case with the Roth 401k. And so, if we look at trying to get money over into that Roth 401k, yes, we're paying taxes on it now, which sucks. But for most of our guys, hey, I'm making a good income now.
Yeah.
Most of them don't really even notice the tax bill, so to speak.
Well, let's talk about that since we're bantering this back and forth.
Yeah.
It sucks, but does it suck that bad? Like if you really think about it, we're in historically low tax rates. So why not go ahead, devil that you know, right? So why not go ahead and pay that animal now? Truly, ask yourself, we got 35, I think the debt clock's at $35 trillion now.
Going up
taxes probably have... Yeah, they got to go up, man.
Yeah.
So, it's the devil that you know. So, yeah, if you can do that, pay the tax bill now.
Yeah, absolutely. And so, and especially for the younger pilots, but dude, if you're 62 and retiring in 3 years at mandatory retirement date, you're still young, in my opinion.
Oh, yeah.
You got a 30-year retirement in front of you.
At least 2025, yeah.
Yeah. And so I would be really trying to get as much into Roth as possible. And ultimately what it manifests in is now we've grown this big bucket of money that we can spend in retirement that doesn't impact anything else I have going on. And so when we work with our guys that are retired, what we frequently see is, oh man, I got all this money in my tax deferred 401k then that gets moved into an IRA. and they're just struggling with the fact that I got to take all these required distributions when I get into my 70s, and then it impacts my Social Security, and I got to pay taxes on Social Security, and then it impacts my Medicare. I got to pay double, triple, even quintuple, with the IRMAA. And so these are things, dude, even most guys that are 55 don't give two flying rips about. And I understand, but having a plan is all about showing up at a certain place of your life and saying, man, I'm glad I did that, versus, man, I wish I would have done that.
Oh, exactly. Well, I mean, all right. So you're talking about pilots here, right? And you work with pilots. What do you guys do? You guys have checklists, right? Before you guys take off, right? You guys are going through this list of things you got to check to make sure, the safety checks, make sure everything's groovy, right? You're talking about the same kind of thing, like a retirement checklist, a planning checklist of some sort. Yeah, maybe you're not thinking about it at 52 like I am right now or whatever, but at 62, it's going to tick you right off that you got to deal with this.
And honestly, you're bringing up a good point. Like, we have that tax planning checklist that we go through all of our clients. So we'll include that in the show notes. And ultimately, like that checklist, I mean, you're hitting the nail on the head. I mean, we have the pre-flight, you have the during flight stuff that they do. We have the landing and if there's some sort of emergency, I mean, it's all checklist based. And so the same thing, this tax planning checklist just goes through and figures out, what all do I have going on in my life? Are there other deductions that I can take? And then also, am I saving the most effective way, especially in my largest, I mean, for the pilots that we work with, the 401k is the largest wealth building tool that we have. And so what we do with it in terms of how we invest it, and then also like the location of where we invest it, after tax, tax deferred or tax free, all have gigantic implications into what we are going to do in retirement later, and how we're going to pay ourselves, and what the tax rates are going to, penalize or not penalize us based off of how we've done. And so ultimately, I think, if we can look at what they got going on, there's going to be a lot of advisors that tell you, hey, you're in a higher tax bracket, just do the tax deferred now and then deal with it later. But man, so many of the CPAs I work with tell me all the time, dude, tax rates absolutely have to go up, first of all. And then the second big piece is you get the match in the Roth.
Yeah.
It's one thing.
If your company offers that, you should definitely be taking advantage of it. Yeah,
absolutely. And all of our major carriers, Delta, United, Spirit, all their Fidelity brokerage accounts, it all gets matched over in the Roth. And that's such a huge benefit, because you're putting in your, let's say your max of $24,000 a year, and then you're getting the pilots to get an extra match. And so that Roth,
and if you're over 50, that's $30,000 a year for the current numbers, right? Yep.
I mean, it gets big fast. And so, for somebody who's a higher earner, should they be converting their IRA to Roth right now? I don't know. Maybe not.
Possibly, right.
But when you're able to contribute to it, and you're paying the taxes through your payroll deduction, and the match is going in the Roth, oh, dude, it's money. It is money, man. And so I just haven't found a scenario where it doesn't make sense. Yes, your maybe gross account balance might be a little smaller, but you don't have a 30 to 40% lien. If you picture like the value of your house, either being mortgage free or having a 40% mortgage on it.
Yep.
Dude, I'll take a little bit lower house that's debt free. And that's what we're trying to just get you debt free from the government.
Because you said it earlier, man. If you're deferring all this down the road, then you got to start pulling it later. Those RMDs are going to come back to bite you. But it's also the income structure and how you're pulling it out, because it can make a massive difference in that, even just the IRMAA charges. Oh, yeah. I was just doing a case scenario with someone the other day, and it's a different show, so I won't be able to share that information. But suffice it to say, over a 10-year window, they had broke it down where it was going to save this particular client like about $120,000 in just IRMAA fees.
Yeah.
Which was just nuts. And if you're not sure what IRMAA fees are, you're paying it. So you're going to have to deal with that, right? And I think we've talked about it a little bit before, and I'm sure we'll go into further detail on it, but it's part of the Medicare, so it's, I mean, when you pull one lever in retirement, it's a Rube Goldberg machine. It affects a whole bunch of other stuff, right? It's build a better mousetrap is what we're talking about here.
Absolutely.
Yeah. So any final thoughts?
Yeah. I mean, I think the final thoughts here, brother, I mean, get your 401k debt free, man. You know what I mean? I mean, the government as a ruthless debt collector.
Get their hands off of it.
And she's going to get paid eventually.
Yeah.
And so if we can do it now with, like you said, what the rates are known, we can get that match tax-free.
Yeah.
And then we start to work this plan over time. It is a beautiful thing when you show up in retirement. And that is going to be one of those things that you look back and say, man, I'm glad I did this versus, I mean, dude, the people that just come see us right at retirement every time, man, I wish I would have. And you don't want to show up there with those regrets because you can take advantage of these opportunities in your 401k right now and start to get it growing tax-free.
Is your 401k working as hard as you are? Let's find out at thepilotsplanner.com to get started with your free full thrust 401k toolkit. Come see what a good financial co-pilot can do to help make sure your retirement is ready to take flight. Visit us at thepilotsplanner.com. That's thepilotsplanner.com.
Well, there you go. That's going to wrap it up for this week. And I'll leave you this one final thought. I was always taught that you have these two relatives that have their hand in your pocket as you go through your life. It's our Uncle Sam and our Aunt Irma. So you want to make sure that you're dealing with those two relatives to try to keep their hand out of your pocket as much as possible. And tax efficiency, tax planning is a long way in doing that. If you need some help, reach out to Scott at thepilotsplanner.com. That's thepilotsplanner.com. We'll have the information on the screen. As Scott said earlier, check the show notes. We'll put that tax planning checklist in there as well. So a lot of good content there. So go check that out. Don't forget to subscribe to us on Apple, Spotify, and YouTube. Hit the subscribe button, ring the notification bell, and we will see you guys next time here on the Wealthy Pilots Podcast with Scott Osborn.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.